Stop what you're doing right now. This second. I don't care if you're in the shower. Get out and grab a towel. I don't care if you're walking your dog. He can wait. I don't care if you're swiping right on dating apps. She's never going to match you back anyway. This is more important than whatever you think you're doing right now. Are we clear? Good. Ladies and gentlemen, it's January 15th, 2026. And in the last 48 hours, something happened that has never, and I mean never, happened in the modern history of the United States Mint. Something that proves beyond any shadow of doubt that the silver market is breaking in real time. Something that reveals the desperation of the institutions who are fighting to keep this charade going for just a few more days. Yesterday, January 14th at 3:45 p.m. Eastern Standard Time, if you tried to visit the United States Mint website to buy a Silver Eagle, the most recognized, most liquid silver coin in the world, the Buy Now button was gone. Not grayed out, not showing out of stock, completely vanished, erased from the website like it never existed. The product pages were still there, the photos were still there, the descriptions were still there, but the ability to actually exchange your US dollars for physical silver, that fundamental function that a sovereign mint is supposed to provide, had been removed from existence. No press conference, no official statement. Just a leaked email to authorized distributors around 6 p.m. citing market volatility as the reason for the suspension. Meanwhile, CNBC ran a segment this morning calling it a temporary technical suspension. Bloomberg's headline read, "Mint pauses sales amid price spike, precautionary move." They're framing this like it's responsible risk management, like the Mint is just being careful because silver went up too fast. Here's what I need you to understand right now before we go any further. The screen is lying to you. The US Mint didn't stop selling because the price is too high. They stopped because the silver is gone. They cannot source the metal, the vaults are empty, the supply chains are broken, and the paper price you see on your screen has completely disconnected from physical reality. But that's not even the most important thing that happened. Because today, January 15th, 2026, during the New York trading session, we witnessed one of the most blatant, most coordinated, most obvious manipulation events I have seen in 12 years of tracking this market. Today, silver opened at $90.50, strong, holding above the psychological $90 level, building momentum toward $95, toward $100. The physical market was screaming, the premiums were exploding. Everything suggested we were about to break out to the upside. And then around 10:30 a.m. Eastern Time, the hammer came down. Massive sell orders, institutional size, coordinated waves of selling pressure designed to do one thing and one thing only: create panic, drive the price down, trigger stop losses, force retail traders out of their long positions. Within 90 minutes, silver dropped from $91.50 to $87.12, a 438 drop, a 4.8% crash in the middle of the New York session on massive volume. Thousands of retail traders got stopped out. Thousands of long positions got liquidated automatically. Thousands of individual investors who bought silver at $88 or $89 with tight stops at $87 or $86, they got taken out. They got forced to sell at the worst possible price. They became the exit liquidity for the institutions, and then just as quickly as it started, the selling stopped. The price immediately recovered. $87 became $88, then $89, then $90, then back to $91 where we are right now as I record this. The entire move down and back up happened in less than 4 hours, a engineered dip designed specifically to create liquidity, to create confusion, to shake out the day traders who are the bread and butter, the easy targets for these institutions. Let me be very, very clear about what you just witnessed. This was not natural price discovery. This was not genuine selling pressure. This was not the market deciding silver should be at $87 instead of $91. This was a coordinated liquidity grab, a stop hunt, a manipulation event designed to steal your positions before the real move higher begins. And if you got stopped out today, if you're sitting there right now looking at your closed position wondering what the hell just happened, I need you to understand something. You fell into their trap. You did exactly what they wanted you to do. You gave them your silver at 87, 88s, and now they're going to ride it to $100, $120, $150 while you watch from the sidelines, angry and confused. But here's the good news. If you're still holding your position, if you had a wide enough stop, or if you're holding physical that can't be forcibly liquidated, you survived. You're still in the game. And what I'm about to explain to you is going to ensure you never fall for this manipulation again. I'm a private commodities analyst. I've been stacking physical silver for 12 years. And I built this channel because I was tired of watching retail traders get systematically robbed by institutions who have infinite capital, perfect information, and the ability to manipulate price at will. My mission is to protect you, to warn you, to help you understand how this rigged game actually works so that you can position yourself on the winning side. So pay very close attention to what I'm about to explain, because understanding the difference between day trading and holding, understanding why day traders are the preferred prey of institutional predators, This understanding could save you tens of thousands of dollars, maybe hundreds of thousands, maybe your entire account. Let me start by showing you exactly what happened today in excruciating detail, because when you see the pattern, when you understand the mechanics, you'll never be fooled by it again. Silver opened the New York session at approximately $91.50 per ounce. Gold was at $4,739. The gold to silver ratio was sitting around 50.8 to 1. Everything looked normal, orderly. The chart showed a healthy consolidation above $90 with building momentum. And then at 10:33 a.m. Eastern Time, the first wave hit. A sell order for 2,500 contracts, that's 12.5 million ounces of paper silver, hit the COMEX in a single block, not spread out over hours, not carefully managed to minimize market impact. A dump designed to move the price. The price ticked down from $91.50 to $91.20. Then another wave, another 1,800 contracts. $91.20 became $90.80. The selling was relentless, mechanical, algorithmic. Every time the price tried to bounce, another wave of selling pressure pushed it back down. At $90, the first cluster of retail stop losses triggered. Every day trader who bought at $88.50 with a tight $2 stop at $90, just to be safe, their positions got liquidated automatically. They didn't choose to sell. The market forced them out. But the institutions could see the order book. They could see where all the stops were clustered. And there was a massive wall of stops at $88. So they pushed harder. More selling, more pressure. $90 became $89, then $88, then $87 to $50. At each level, more stops triggered. More retail positions got transferred to institutional hands at bargain prices. The cascade was mechanical. The execution was surgical. This is what it looks like when banks engineer a liquidity event. The low of the move was $87.12. Let me say that again. $87.12. From $91.50 to $87.12 in under 90 minutes. A 438 drop on massive volume that appeared out of nowhere. And then, and this is the smoking gun that proves it was manipulation, the selling stopped instantly. Not gradually. Instantly. Like someone flipped a switch. And buyers immediately stepped in. Within 30 minutes, we were back at $89. Within 2 hours, back at $91. The entire round trip happened in a single New York session. Now let me explain why this pattern proves manipulation beyond any doubt. In a normal market with genuine selling pressure, when price drops 5% in 90 minutes, it stays down for a while. Sellers keep selling, the narrative shifts, people start questioning the bull case. It takes days or weeks for confidence to return and for buyers to step back in. But that's not what happened today. The recovery was immediate. The moment the stops were triggered and the retail traders were liquidated, the price snapped back like a rubber band. Why? Because the selling was never real. It was manufactured specifically to create liquidity, to force retail to sell so that institutions could buy. This is the playbook. This is how it works. And if you understand this, you'll never fall for it again. The institutions need to accumulate silver. They need to build long positions. They need to cover shorts. But they can't just buy at market prices because that would push the price higher and make their accumulation more expensive. So what do? They engineer a fake crash. They dump paper contracts to drive the price down. They trigger all the retail stops. They create panic and confusion. And then, once retail has been shaken out and forced to sell at low prices, the institutions step in and buy everything at a discount. It's theft. It's manipulation. And it's perfectly legal because they're not explicitly breaking any rules. They're just using their size advantage and their information advantage to systematically rob smaller traders. Now let me connect this to what happened with the US Mint, because these two events, the Mint going dark and today's engineered crash, they're not separate stories. They're part of the same pattern. They're both symptoms of a market that is breaking down in real time. The US Mint went dark on January 14th because they cannot source physical silver at the paper price. Think about what that means. The sovereign mint of the world's reserve currency, the institution that is supposed to be the anchor of price discovery for physical silver, they cannot get metal. The vaults are empty. The supply chains are broken. The wholesalers they normally buy from are either sold out or quoting prices so high that the mint can't make the economics work. Let me explain the economics. The Mint typically buys silver from wholesalers at spot price, plus a small premium, maybe $2-3 per ounce. They stamp it into eagles. They add their $6 or $8 markup. They sell it to the public at spot plus 8 to 10. That's how the business model works. But right now, the wholesalers aren't quoting spot plus $2. They're quoting spot plus $30. Or spot plus $40. Or they're flat out saying, we don't have any metal to sell you at any price. Because there's a physical shortage, because industrial users are panic buying, because sovereign wealth funds are accumulating, because the physical market has completely disconnected from the paper market. So the mint is stuck. They can't buy planchets at $120 per ounce and sell eagles at 95s. They would lose money on every coin. They can't raise their retail price to $150 per coin because that would be openly admitting that the spot price is fake. So they do the only thing they can do. They shut down sales entirely and hope the situation resolves itself. Except the situation is not resolving itself. It's getting worse. And today's crash to $87, that engineered dip that created liquidity for the institutions, that was partially designed to create the illusion that everything is fine, that the rally is over, that the shortage isn't real, that you should sell your physical before it crashes further. It's psychological warfare, and most retail traders fall for it. Now let me teach you the fundamental lesson that separates winners from losers in this market, the lesson that will protect you from ever being shaken out again, the lesson about why day traders are the easiest prey for institutional predators. Day traders, people who try to catch quick moves with tight stops, who trade in and out multiple times per day or per week, who think they can outsmart the market with technical analysis and tight risk management, have a 99% failure rate. 99%. That's not my opinion. That's documented statistics from every major brokerage and every academic study on retail trading behavior. 99% of day traders lose money over time. Why? Because day trading is a game of speed, information, and execution quality, and retail traders lose on all three dimensions. Institutions have faster connections, they have better information, they can see the order book, they can move size without slippage, they have algorithms that can execute thousands of trades per second. You, the retail day trader, you're bringing a knife to a gunfight. You're trying to compete with supercomputers and PhD mathematicians and billion-dollar hedge funds who have spent decades perfecting these strategies. And you think you're going to win with your $10,000 account and your TradingView subscription? You're not going to win. You're going to get systematically destroyed. Today's crash to $87 is proof. Every retail day trader who had a tight stop at $88 or $87, they all got taken out. They all became exit liquidity. They all handed their shares to the institutions at the worst possible prices. Now compare that to swing traders and long-term holders, people who buy with the intention of holding for weeks, months, or years, people who use wide stops that account for normal volatility and manipulation, people who understand that price doesn't move in straight lines and that the institutions will run stop hunts regularly. Swing traders have failure rates around 40-50%. Still not great odds, but dramatically better than day traders. Why? Because swing traders don't get shaken out by short-term volatility. When the institutions run a stop hunt like they did today, swing traders with stops at $75 or $70 don't get touched. They ride through the manipulation. They're still in their positions tonight. They're still profitable. They didn't give their shares away at $87. And long-term holders, people who own physical silver in a safe or allocated storage with no leverage and no stops, they're completely immune to manipulation. The institutions can crash the paper price to $50 if they want. It doesn't matter. Physical holders can't be forced out, they can't be liquidated, they simply wait. And eventually the physical price and paper price reconcile, with the paper price rising to meet the physical price, never the other way around. This is the hierarchy of survival in a manipulated market. Tier 1, highest survival, physical holders with no leverage. Tier 2, swing traders with wide stops, 10-15% below current price. Tier 3, day traders with tight stops, 2-5% below current price. If you're in Tier 3, you will get destroyed. It's only a matter of time. Today might not be the day, but eventually they will engineer a move that takes you out, and you will sell at the bottom and watch the price recover without you. If you're in Tier 2, you have a fighting chance. You'll survive most manipulation attempts. You'll ride through the volatility. You'll still be positioned when the real move, higher, begins. If you're in Tier 1, you're unshakable. You cannot be forced out. You simply hold and wait for the system to break. Now let me show you the mathematics of why this matters, using today's move as an example. Let's say you bought silver at $89 with a position size of 100 ounces. That's $8,900 invested. You have two choices for where to place your stop. Choice A, day trader, tight stop. Stop at $87. That's a $2 risk per ounce or $200 total risk. Feel safe, disciplined, professional. But what happened today? You got stopped out at 87. You took a $200 loss, and now silver is back at $91. You missed a $4 gain per ounce, which would have been $400 profit. Net result, $200 realized loss, $400 opportunity cost, suckers, $600 total damage. Choice B, swing trader, wide stop. Stop at $75. That's a $14 risk per ounce or $400 total risk. Feels scary, uncomfortable, risky. But what happened today? The low was $87.12, nowhere near your $75 stop. You didn't get touched. You're still in the position. And with silver now at $91, you're up $2 per ounce, trying to $200 of profit. Net result, $200 unrealized profit, still positioned for further gains. Same entry price, same market conditions, but choice A lost money and is out of the position. Choice B made money and is still positioned for the move to 100 plus. The only difference was the width of the stop. But wait, you're thinking. If I use a $14 stop instead of a $2 stop, I need much smaller position size to maintain the same dollar risk. Exactly. That's the point. That's proper risk management. If you're willing to risk $200 on a trade, you don't put $200 at risk with a $2 stop on 100 ounces. You put $200 at risk with a $14 stop on 14 ounces. Same $200 total risk. But now your stop is wide enough that normal volatility and institutional manipulation don't shake you out. You're positioned to survive and capture the real move. This is what professional traders understand that retail doesn't. Position size and stop width must be inversely adjusted based on volatility. In a volatile, manipulated market like silver, you must use wide stops, period. And if that means smaller position size to maintain your risk tolerance, so be it. Better to be in the trade with a small position than out of the trade entirely because you got stopped out. Now let me explain what's actually happening in the silver market right now at the structural level. Because today's crash and the mint going dark, these aren't isolated incidents. They're symptoms of a systemic breakdown that's been building for years and is now reaching critical mass. The silver market operates on what's called a fractional reserve system. Just like banks don't actually hold all the cash that depositors have claims to, the bullion banking system doesn't actually hold all the silver that paper contracts represent. The COMEX, the LBMA in London, the ETFs, they all operate on the assumption that most people won't actually demand physical delivery. They assume 99% of contracts will be rolled forward or cash settled. This system works fine as long as that assumption holds. But what happens when people start demanding physical delivery? What happens when industrial users can't get metal and start standing for delivery on their futures contracts? What happens when sovereign wealth funds decide they want allocated, segregated storage instead of unallocated paper claims? The system breaks, because there isn't enough physical metal to back all the paper claims. The estimates vary, but most analysts think the ratio of paper claims to physical metal is somewhere between 100.1 and 500.1. Let's be conservative and say it's 250.1. That means for every ounce of physical silver sitting in a vault, there are 250 ounces of paper claims on that same silver. This is called rehypothecation. The same ounce gets pledged to multiple parties. Everyone thinks they own silver, but really they just own a claim on silver. And as long as they never actually try to take possession, the system keeps humming along. But now people are trying to take possession. Industrial users need the metal. Sovereign buyers want it in their own vaults. Retail investors have learned from past failures and are demanding physical delivery. And suddenly the system doesn't have enough metal to satisfy all the claims. This is what's called a fractional reserve bank run. Everyone rushes to the teller at the same time demanding their deposits. And the bank has to admit they don't actually have everyone's money. They lent it out, they invested it, they gambled with it, and now they can't give it back. The US Mint going dark is the equivalent of the bank putting up a temporarily closed sign. They're hoping that if they stop taking new demands for withdrawals, the panic will subside and they can sort out the mess behind the scenes. But the panic isn't subsiding, it's accelerating. Let me show you the data that proves we're in the endgame of this fractional reserve collapse. As of January 14th, the COMEX registered inventory, that's the silver that's actually available for delivery, not just stored at the exchange, stands at approximately 31 million ounces. Meanwhile, the open interest in COMEX silver futures represents over 850 million ounces of claims. That's a ratio of 27.1 paper claims for every ounce of deliverable silver. But it gets worse. In January alone, 36.06 million ounces are standing for delivery. That's 7,212 contracts demanding physical metal. If even half of those contracts actually demand delivery instead of rolling forward, the registered vaults would be completely drained within weeks. Within weeks. And the institutions know this. They can see the delivery numbers, they can see the vaults draining, they can see the mint going dark. They know the system is breaking. So what do? They try to scare retail into selling. They engineer crashes like today's move to $87. They trigger stops. They create panic. Because every ounce they can shake loose from retail traders is one less ounce they have to source from the dwindling vaults. This is why I keep emphasizing, do not sell. Do not give them your silver. Do not fall for their manipulation. Because what they're really doing is trying to extend the life of a system that's already dead. They just haven't announced the funeral yet. Now let me tell you about the other dominoes that are about to fall, because the US Mint going dark is just the first domino. The Royal Canadian Mint is next. The Perth Mint in Australia is wobbling. And the big one, the LBMA in London, is showing serious stress fractures. The LBMA is the nerve center of the global precious metals market. More silver trades through London than anywhere else on Earth. The London vaults hold approximately 1 billion ounces of silver, or at least they claim to. But here's the thing about those London vaults. Most of that silver is unallocated, meaning you don't own a specific bar with your name on it. You own a claim on silver that exists somewhere in the vault system. This is fractional reserve bullion banking at its finest. The same ounce gets counted multiple times. The same bar backs multiple claims. And as long as nobody demands physical delivery, everything works fine. But what happens when people start demanding allocated storage? What happens when they want their specific bars in segregated vaults with serial numbers verified? The system freezes, because there aren't enough bars. The 1 billion ounces they claim to hold might really be 300 million ounces that are counted multiple times on different balance sheets. And when that discrepancy gets exposed, when the LBMA has to admit they can't honor physical delivery requests because the metal isn't actually there, that's when the paper market officially dies. I'm hearing whispers, and these are just whispers, not confirmed reports, that certain large players have been having difficulty taking delivery from London over the past 2 weeks. Delays, excuses, offers to cash settle instead of delivering physical bars. If those whispers turn into confirmed reports, if the LBMA officially suspends physical withdrawals, the game is over. The paper price becomes fiction, and the physical price becomes reality. And what is the physical price? Well, let me show you. While the COMEX spot price says $91, let me tell you what real silver is trading for in the physical market. Generic silver rounds from private dealers, $135, $145 per ounce, 50-60% premium over spot. Silver Eagles, when you can find them, $150, $160 per ounce, 100 Oz bars with immediate delivery, $125, $130 per ounce. India physical market, 290,000 rupees per kilogram, margin approximately $132 per ounce. Shanghai Gold Exchange yesterday, 704 yuan, margin approximately $97 per ounce. 10% premium over COMEX. Do you see the pattern? The physical market is trading $40, $50 above the paper price. That spread is the crack in the dam. That spread is the market screaming that the paper price is fiction and physical scarcity is real. Now let me tell you exactly what I'm doing with my own capital, and I want to be very clear. This is not financial advice. This is what I'm personally doing based on my analysis, my risk tolerance, and my time horizon. Your situation is different. You need to make your own decisions. What I'm holding, all of my physical silver positions, every ounce. I'm not selling a single coin or bar until we're well above $150 minimum. The premiums I'm seeing tell me the real price is already there. The paper price just hasn't caught up yet. What I'm watching, the $91.50 level. If silver holds above $91.50 for 3 consecutive daily closes, I'm interpreting that as breakout confirmation, and I'm adding to positions through mining stocks, not physical due to premiums, the LBMA vault data. If London unallocated holdings drop another 10% from current levels, that's a 5-alarm fire. That means the fractional reserve ratio is breaking down. The Mint. If they come back online, but with 120 plus pricing per eagle, that's confirmation that the physical floor has permanently reset higher. What I'm not doing, I'm not day trading, I'm not using tight stops, I'm not trying to catch every wiggle. Today's engineered crash to $87 was designed to take out people who do that. I survived because I'm positioned like a swing trader, not a day trader. My allocation, approximately 15% of liquid net worth in physical silver and silver miners combined. That's enough that, if I'm right, it's life-changing. But not so much that if I'm wrong, it destroys me. Risk management is about surviving to fight another day. My stop levels. For any leveraged or futures positions, which I don't currently have, I would place stops no tighter than 15% below current price. With silver at $91, that means stops at $77 or lower. Anything tighter, and you're just donating money to the institutions. Now let me address the question everyone is asking. What happens next? Where does this go? Here are the scenarios I'm gaming out based on probabilities. Scenario 1, 60% probability. The slow grind. The Mint stays dark for 2 to 3 weeks. They come back with rationing, 2 coins per customer max, and higher prices, 120 plus per eagle. The LBMA muddles through with delays but no official suspension. Silver chops between 85 105 for the next month while the market slowly realizes the deficit is real. Then we get a breakout to 120, 130 by March. This is the most likely scenario because markets rarely resolve things quickly. Scenario 2, 30% probability. The squeeze CumEx delivery failures force cash settlement or force majeure within 2 to 3 weeks. The paper market breaks. Silver gaps from $90 to $140 in a single day as the spread between paper and physical collapses. Miners go parabolic. This is the dramatic scenario everyone hopes for. Scenario 3, 10% probability. The washout, coordinated institutional selling pressure. Plus, CME margin hikes push silver down to 75 to 78 in a final capitulation move designed to shake out every last weak hand. But the physical market doesn't follow. Premiums explode to 100% over spot. The disconnect becomes so obvious that even mainstream media can't ignore it. Then we get scenario 2 as the reset happens violently. In all three scenarios, being positioned in physical or miners with wide stops is the right move. The only losing scenario is being a day trader with tight stops who gets shaken out of winning positions. Here's my final message, and I need you to really hear this because it might be the most important thing I say in this entire video. Do not sell. I don't care what the price does tomorrow. I don't care if they engineer another crash to 85s or 80 TAWs or $80. I don't care if CNBC brings on analysts who say the rally is over. I don't care if your broker calls you suggesting you take profits. Do not sell. The US Mint going dark is proof the system is broken. Today's crash to $87 and immediate recovery is proof the institutions are desperate. The 40-50 premiums in the physical market are proof the paper price is fiction. If you sell now, you're giving your silver to the institutions at exactly the moment they need it most. You're becoming exit liquidity for a system that's collapsing. You're handing over your winning position right before it pays off. Hold your physical. Widen your stops if you're trading paper. Think in terms of months, not days, because the day traders who got stopped out today at 87s are watching silver trade at $91 tonight and kicking themselves. Don't be them next time. The mint is dark, the vaults are empty, the premiums are screaming, the institutions are desperate, and your only job is to not give them your silver. That's it. That's the whole strategy. Just don't sell. This is not the time to get cute. This is not the time to day trade. This is the time to hold what you have with both hands and wait for the system to break completely. Because when it breaks, when the LBMA suspends withdrawals, or the COMEX declares force majeure, or the mint admits they can't source metal, the price is going to gap so high so fast that you won't have time to get back in. The target is $150, $200 minimum. The timeline is months, not years. The opportunity is now, but only for those who can survive the manipulation without getting shaken out. I'm holding. The question is, are you? Remember to like and subscribe. Watch my deep dive on the London situation to understand what happens if the LBMA breaks. And whatever you do, don't fall for their manipulation. They want you to sell at $87. Don't give them the satisfaction. This is your analyst signing off, January 15th, 2026. The mint is dark, the institutions are desperate, and the endgame has begun. Hold your silver.